The first thing we'll do is prepare a schedule of expected cash collections. We'll prepare this for January, February, and March. Our primary source of collecting cash is going to be from sales. So we do need to go back and look at what our sales will be to determine this. Sales are expected to be $200,000, $240,000, and $180,000 over the 3 months, and we expect to collect 70% during the month of the sale, 20% in the month following the sale, and the remainder is collected 2 months following the sale. Sales in November were $80,000 and December $90,000. I'm going to put that on this schedule so we can remember what all of our sales were. All of these were just given. And our policy, or our expectations for collections, we believe that we'll collect 70% during the month of the sale, 20% in the month following the sale, and 10% 2 months following the sale. So if we begin to look at what we're going to collect in January, we know that we'll collect 70% of January sales in the month of January. And we will collect 20% of December's sales and 10% of November's sales. The way you need to think about this is the month of the sale during January, that will be January, and January is 1 month following sales that occurred in December. So we'll collect 20% of December's sales, and January is 2 months following sales that occurred in November. When we do our math calculations, we'll get that of the $80,000 in sales during November, we'll collect $8,000. 20% of the sales that occurred in December means that in January we'll collect $18,000. And 70% of the sales in January is $140,000. So our total cash collections are expected to be $166,000. We will not be collecting in advance from February and March. That's typically not how customers pay for goods that they buy. They don't pay for them in advance in very many industries. Now you can see that while we have $200,000 in sales during January, our cash collections are only expected to be $166,000. We'll do the same thing for February. We don't expect to collect anything from November because we collected that in November, December, and January. We expect to collect 70% of February's sales in February, 20% of January's sales, and 10% of December's sales. 10% of $90,000 is $9,000, 20% of $200,000 is $40,000, and 70% of $240,000 is $168,000. We don't expect to collect in advance from our sales that we'll have in March. So total cash receipts during February, $217,000. In March, we will not be collecting from November or December's sales, and we'll collect 70% of March's sales during March, 20% of February's sales, and 10% of January's sales. 10% of $200,000 is $20,000. 20% of $240,000 is $48,000, and 70% of $180,000 is $126,000. Total cash receipts during March, $194,000. So you can see that while sales are $200,000 in January, it takes 3 months to collect that $200,000. Next, we'll prepare the accounts receivable budget. You know how accounts receivable works. You start with a beginning accounts receivable balance. You add sales on account. That increases accounts receivable. What decreases accounts receivable? Cash receipts from credit sales. And that will give us our ending accounts receivable balance. We'll need to reference our information. We were told that accounts receivable would begin at $35,000. Sales on account are given to be $200,000 during the month of January. And we calculated cash receipts from credit sales to be $166,000 in our cash receipts schedule. This leaves us an ending accounts receivable balance of $69,000. In February, we'll begin at $69,000. We'll add sales on account of $240,000. We'll subtract the cash receipts from sales that we just recently calculated, $217,000. That leaves ending accounts receivable of $92,000. These are the amounts that will go on the balance sheet for January and February for accounts receivable.